When we look at a successful business scaling up its operations, we often imagine a perfectly frictionless machine. But when analysts project that growth into the future using a standard discounted cash flow model, they often overlook a structural mismatch. They project aggressive revenue growth while holding capital expenditures perfectly flat. This creates a double counting error. The model inflates free cash flow by capturing the profits of expansion, but ignores the cash outlays required to build that new capacity. In corporate finance, growth is not free. Every dollar of new revenue must be earned through a corresponding reinvestment into the company's asset base. Standard accounting metrics provide the raw data, but they don't distinguish between a business that scales efficiently and one that is consuming its own capital to maintain the illusion of growth. To find the true intrinsic value, the financial architecture of the firm must be reconstructed. Take the logistics industry as a starting point. If you look at a standard cash flow statement for a shipping company, you'll see a single line item for capital expenditures. That one number aggregates two very different types of spending. The first is maintenance CapEx. This is the mandatory economic cost required to sustain current unit volume. If a delivery truck breaks down and needs a new engine to keep running the same route, that outlay is maintenance. The second is growth CapEx. This is discretionary investment deployed to capture new markets, like purchasing an entirely new fleet of trucks to service a new delivery route. Because management rarely splits these numbers in public filings, analysts estimate them by relying on a framework developed by Columbia University professor Bruce Greenwald. Assuming stable asset efficiency, multiply the historical ratio of property, plant, and equipment to sales by the current year's increase in sales. This gives growth CapEx. Then take total reported capital expenditures and remove that growth block. What remains is true maintenance CapEx. Without isolating this exact figure, it is impossible to determine the true cash cost of simply keeping the business alive. The maintenance figure serves as the foundation for earnings power value, or EPV. Instead of forecasting decades of expansion, EPV values a business based purely on its sustainable, normalized present earnings, assuming zero future growth. The calculation is straightforward. You divide the company's adjusted earnings by its weighted average cost of capital, but the critical step happens inside the numerator. You remove the standard accounting depreciation and replace it with the maintenance CapEx we just calculated. Accounting depreciation is an arbitrary schedule. Maintenance CapEx reflects the actual cash required to prevent the business from shrinking. By making this swap and assuming zero growth, EPV establishes a conservative floor for intrinsic value. It strips away the speculative growth premiums that can cause traditional models to fail. While EPV corrects the math for physical capital, the technology sector presents a different challenge. Current accounting standards hide massive reinvestments behind the appearance of asset-light balance sheets. Under U.S. GAAP, companies must immediately expense all research and development. This suppresses their current earnings while keeping their asset base small. To correct this, we rely on Aswath-Damodaran's methodology for recategorizing these outlays. As this slide outlines, adjusted net capital expenditures must include both R&D expenses and the acquisitions of other firms. The 1999 Cisco Systems valuation serves as a definitive case study for this hidden reinvestment trap. Cisco reported a baseline net CapEx of $98 million, but adding back R&D and acquisition expenditures as actual investments and subtracting the amortization of those newly created assets, the result is a true economic reinvestment of $3.7 billion. Recalculating these numbers forces an expansion of the company's invested capital base. They were deploying billions. It just wasn't categorized as capital on the balance sheet. Treating R&D and M&A as operating expenses creates the appearance of high returns, masking the true cost of staying competitive in the tech sector. This distortion extends to the retail sector through a different channel, off-balance sheet operating leases. Historically, rent was treated simply as an operating expense, but the transition to the IFRS 16 standard forced companies to capitalize these leases, moving them onto the balance sheet as liabilities. This graphic outlines the mechanical impact this accounting shift has on the enterprise value to EBITDA valuation multiple. First, look at the numerator. EBITDA increases because operating rent is removed from the income statement and replaced by interest and depreciation. Then look at the denominator. Enterprise value increases because those newly capitalized lease liabilities are now treated as financial debt. Unless analysts manually standardize these lease adjustments, they will suffer a comparability blind spot when valuing peers operating under different accounting standards. Adjusting CapEx, capitalizing R&D, and standardizing leases all serve one central analytical purpose: calculating a structurally sound return on invested capital. The core equation for ROIC is net operating profit after tax divided by invested capital, but we use the true adjusted figures. The adjustments from Act 2 expand the denominator, forcing the business to prove operating efficiency against a much larger, truthful calcal base. This leads to the final capital allocation test, comparing this newly corrected ROIC against the company's weighted average cost of capital, or WACC. True economic value is only created when ROIC exceeds WACC, meaning every dollar deployed earns more than it costs. But the inverse is equally true. If the adjusted ROIC falls below WACC, the underlying economics of the business are broken. This leads to a counterintuitive rule in finance. If ROIC is lower than WACC, deploying growth CapEx to scale revenues actively destroys shareholder value faster. Pumping capital into a low-return business is like forcing a massive industrial cargo ship through thick Arctic ice. The harder you push the engines, the more fuel you burn, but you aren't moving forward. Growth is not inherently good. It is a multiplier. It multiplies wealth when returns are high and incinerates cash when returns are negative. Professional valuation is not a data entry exercise. It requires tearing down accounting illusions and restructuring the financial architecture to reflect pure economic reality.